Today, we will talk about cost, insurance, and freight, CIF. Cost, insurance, and freight is an international shipping agreement, which represents the charges paid by a seller to cover the costs, insurance, and freight of a buyer's order while the cargo is in transit. Cost, insurance, and freight only applies to goods transported via a waterway, sea, or ocean. The goods are exported to the buyer's port named in the sales contract. Once the goods are loaded onto the vessel, the risk of loss or damage is transferred from the seller to the buyer. The contract terms of CIF define when the liability of the seller ends and the liability of the buyer begins. CIF is only used when shipping goods overseas or via a waterway. The seller has the responsibility for paying the cost and freight of shipping the goods to the buyer's port of destination. Usually, exporters who have direct access to ships will use CIF. However, the buyer has responsibilities as well, which are outlined below. Under CIF terms, the seller's responsibilities include: the seller must deliver the goods to the ship within the agreed-upon timeframe and provide proof of delivery and loading. Once the goods have arrived at the buyer's destination port, the buyer assumes responsibility for the costs associated with importing and delivering the goods. It's important to note that when shipping internationally, there can be different risk and cost transfer points between the buyer and seller, depending on the type of shipping agreement. Under CIF, the risk transfer is at a different point than the cost transfer. The exact details of the contract will determine when the liability for the goods transfers from seller to buyer. Here are 5 key takeaways. 1. Cost, insurance, and freight, CIF, is an international commerce term and only applies to goods shipped via a waterway or ocean. 2. With cost, insurance, and freight, the seller covers the costs, insurance, and freight of a buyer's order while in transit. 3. Once the cargo has been delivered to the buyer's destination port, the buyer assumes responsibility for the costs of importing and delivering the goods. 4. However, the risk transfer occurs from the seller to the buyer when the goods have been loaded on the vessel. 5. The buyer takes ownership of the goods once on the ship, and if the cargo is damaged during transit, the buyer must file a claim with the seller's insurance company. Hope this would help. Thanks for watching.